Bismillahirrahmanirrahim. In the previous class, we discussed about types of audit. We discussed about different types of audit of financial statements, operational audit, compliance audit, statutory audit. Basically, the difference between statutory audit and annual audit is that statutory audit, it is for the joint stock companies, and annual audit, it is basically for the small organizations. This one, annual audit. Then we discussed about interim audit and balance sheet audit. Today we are going to discuss another type of audit that is called cost audit. Cost audit is defined as the verification of cost accounting records. You know what cost accounting record? Manufacturing data and techniques for its accuracy and authenticity. It gets as effective managerial tool for detection of errors and frauds in cost accounting records. Here our purpose is the detection of errors and frauds only in cost accounting records, manufacturing. So cost audit, it is used in manufacturing concerns simply. So what is cost audit? Verification of the cost accounting data. Simply, it is called the cost audit. So the verification of the cost accounting data for the purpose of detection of errors and frauds in cost accounting records is called cost audit. In manufacturing concern, there is, you studied about the cost of goods sold. So the raw material, then labor cost, then factory overhead, and these things, all the things involved in these, the checking of this thing. Then the ninth one, it is management audit. Management audit may be defined as comprehensive examination of the organization structure of a company. You know about the organization structure, top management, then in top management, then there is middle management, then there's lower management. So we are checking this thing. Institution and its plans and objectives, and then checking its plans and objectives, whether the management, they achieved these plans and objectives on time or not. It means just simply, it is checking the human and physical facilities. Management audit is concerned with the audit of human and physical facilities. The main objective of management audit is to see how far the objectives of management are fulfilled. The management, they set some objectives, and in management audit, we are checking whether these objectives are achieved or not. It aims to ascertain whether sound management prevails throughout the organization. We are checking whether the management of the organization, it is sound, it is good or not, and evaluates its efficiency in the system of its operations. And we are checking whether the management is efficient in the operations or not, in different operations of the organization, whether the management is efficient and effective or not. So in management audit, we are just checking the management, whether it is effective and efficient or not. We are checking the efficiency and effectiveness of the management of the organization. Then the last type of audit, it is called continuous audit. A continuous audit is one in which the auditor visits his client office at regular intervals throughout the year to verify the accounts. Auditor is visiting the company regularly throughout the year. The objective of continuous audit may be to get final accounts audited immediately after the closure of accounting year. One objective of the continuous audit is when the year ends, so quickly we will audit the accounts. When the business is very large, so auditor is coming regularly, because when he will come at the end of the year, so it will take too much time for to conduct the audit. It will take too much time. So throughout the year he is coming and he is auditing the accounts. When regular final accounts are required in banks, basically they are using this continuous audit and they need regular final accounts. So that's why they are using continuous audit. For banks, they are using mostly, they need regular accounts. So that's why they are using the continuous audit. So continuous audit, in simple words, it is that type of audit in which auditor is visiting the company throughout the year regularly. So these are different types of audits. Types of auditors. So there are two types of auditors. One is called internal auditors and the second one is independent or external auditor. Internal auditors, they are employed by individual companies to investigate and appraise the effectiveness of company operations for management. Basically, internal auditors, these are hired by the organization itself and they are the employees of the organization. And why they are doing this thing? The one thing is investigation and appraise the effectiveness of company operations, and the second purpose is that they will check, they are regularly there to check whether the operations of the company are effective or not. They are helping the management in checking the efficiency of the operations. So the internal auditor is simply hired by the organization, employed by the organization, the company, and their aim is investigation, checking whether there is no error and fraud, and the accounting policies they followed. The company is following the accounting policies, and the company is following the accounting standards, and checking the effectiveness of operations. They are helping the management in effective operations of the organizations. So this is internal auditor. The second one is independent or external auditor. They are typically certified either by a professional organization or government agency. Basically, independent auditor, external auditor, they are not hired by the organization. They are independent. They are external parties. They are coming at the end of the year and they are checking your accounts. These are basically certified people, and these people are from some professional organizations or from government agency. So the main difference is that internal auditor is hired by the top management, and independent auditor, he's coming from outside the organization. It is from any professional organization, auditing organization, or it is from the government agency. Certification of the auditors. There are different certifications all over the world. One is Certified Public Accountant, CPA, Chartered, Certified Public Accountant. CPA is in, this is Belize, I don't know what is this. Okay, China, Salvador, Guatemala, Hong Kong, Israel, Japan, Kenya, Korea, Malaysia, Philippines, Singapore, Taiwan, and the United States. So these certified public accountants in these countries, they are certified from these certified public accountants. Chartered accountant, CA in Australia. These countries, they have their own bodies. Now, chartered accountants, these are in Australia, Canada, Simon Islands, Hungary, India, and the United Kingdom. These are in these countries. This is in some other language, I can't pronounce it. Okay, I will try. Contador Publico, CP. These are the professional bodies of auditors in Argentina, Chile, Colombia, Ecuador, Mexico, Panama, and Peru. And there are also others. So these are different certification of auditors. In Brazil, China, Salvador, and these countries, there are certified public accountants. These are professional bodies, these are certification of auditors in these countries. Chartered accountants, these are certification in Australia, Canada, some different islands, Hungary, India, and these countries. And these certifications are in Argentina, Chile, and these countries. So these are different certification of auditors. Management assertions and audit objectives. First of all, what is management assertions? Now I will give you a simple example about this. Suppose you are making a mobile. A company is making a mobile. So when they are making a mobile, they are giving you guarantee or warranty card. In warranty card or in guarantee card, they are claiming something, that if something happens in this product, the company will be responsible. This mobile, these are the features of the mobile, and if there is some problem in these features, the company will be responsible, Samsung or iPhone. So these are basically assertions. These are basically the claims that the company is making about this mobile set. Suppose, take another example. An engineer is making a house, is building a house. Now in this house, when he make this house, he is claiming something. What is he claiming? That this house is a very good house. There will be no problem in this house up to 50 years. So these are his claims that up to 50 years I am responsible if something happened in this building. I will give you another example. There are some bridges in Pakistan. And who made these bridges? UK, United Kingdom. And there is expiry written on these bridges. Expiry date. That we are responsible for these up to this date. After this date, we are not responsible. The company who built these bridges, they claim this thing that we are responsible up to suppose up to 2018 we are responsible, but after 2018 we are not responsible for this. So they are claiming this thing that up to 2018 nothing will happen to this bridge. So these are basically the assertions of the company about their product. Assertions about the mobile set, that this is a good mobile set, these are the features, this 64 megapixel camera and the what different other things in mobiles. And they are giving you warranty card and they are giving you guarantee card. So that is what they assert something, they claim something about this product. When engineer is making a house, so he has certain assertions. He has certain claims that this is a very good building and there will be no problem in this building up to this much time. If something happens, I will be responsible. Same is the case of different bridges and roads and these things. So the company who is making something, he is claiming something about this product. Same is the case in accounting. The management, when they are developing financial statements, so they are claiming something that these financial statements are free from errors and frauds. And they are according to standards. So these are basically the claims of the management. Claims of management. When they make financial statements, they are claiming something, that these financial statements are free from errors and frauds and we followed the standards developed by IFRS or GAAP. The claim, so we call it management assertions, the claims of the management. So management assertions, what is management assertions? Are implied or expressed representations by management about classes of transactions and related accounts in the financial statements. When management is developing the accounting standard, when they are recording these transactions and other things. So they are claiming something about these transactions, these classes of transaction and related accounts in the financial statements. Like suppose here is an example. An example of management assertion is that the company's financial statements are prepared based on international financial reporting standard. That is one claim, that the financial statements that we develop, these are according to international financial reporting standard. The audit starts with the financial statements prepared by the clients. Who is the client? The company is the client. And the claims are assertions that the clients makes about these numbers. And there is a claim of the client, there is claim of the company about uh, these numbers in the financial statements, that these financial statements are true and fair, and these are according to financial standards. It is the auditor's job to validate management assertions. Now, what will auditor do? The management claims something, that these financial statements are free from errors and frauds. So now, what will auditor do? He will validate, he will check the management assertions, that the assertions that management developed, we will now check whether it is true or not. In order to do so, the auditor will identify audit objectives, which can be regarded as auditor's counterpart of management assertions. Now he will set some objectives, and accordingly he will check, he will achieve his objective, or auditor will achieve his objective. So in simple words, make it simple. What is management assertions? When management is maintaining accounting record, they are claiming something about this record, that this record is true and fair, and this is according to the international financial reporting standards. This is their claim. Now, when auditor will come, he will check about the claim of the management, whether what management said, it is true or not. Following are the assertions of management regarding its accounting information and financial report. There are different assertions of the management. Now you will understand about these. Assertions about classes of transaction and events for the period under audit. Assertion about account balances at the period end. Assertion about presentation and disclosure. Now we'll discuss these one by one. The first one, assertion about classes of transaction and events for the period under audit. The transactions and events which are recorded in this accounting period, they claim certain assertions. They said something about this. The first thing, occurrence. Transaction and events that have been recorded have occurred and pertain to the entity. Now suppose there is a transaction. Land, debit, and cash, credit. Just I am giving you one example about the classes of transaction. Suppose this is a transaction. They are claiming that we record this transaction because we have evidence of this thing. So there will be legal documents of land related with this transaction. Legal documents. Now, if they record this transaction, they are claiming that yes, the company purchased this land and paid for this land, and they have the legal documents of this land. Any other transaction, so there is evidence of that transaction. So one claim of the company is about the occurrence of transaction, that the transactions and events that have been recorded in the accounting record have occurred. These transactions have occurred and pertain to the entity, and these transactions relate to the entity, and there is evidence. So when auditor will come, he will check the evidence of all these transactions. Any transaction, so there will be evidence of that transaction. Then, so about occurrence, they claim, they make an assertion that all the transactions that are recorded, these transactions relate to the entity. Just like I give you the example of land to cash. Yes, we record this transaction relate to the entity, this transaction relate to this organization, and the evidence is attached with this voucher. The second thing is completeness. All transactions and events that should have been recorded have been recorded. Completeness means all the transactions, we record all the transactions in our accounting record. Nothing is missing in these transactions. So all transactions and events that should have been recorded have been recorded. Means nothing is missing. Each and everything is complete. So all transactions and events that should have been recorded have been recorded. Like in our journal, this is suppose our journal entries, this thing. So we record each and everything, nothing is missing. Everything which happens, which occurs, we record it. So this is another assertion. Accuracy. Amounts and other data relating to recorded transactions and events have been recorded appropriately. We record it accurately. We record it appropriately. The amounts in these transactions. See, we are talking about the transactions. Classes of transactions and events. So events are basically what? Transactions. So all the transactions that we recorded, the amounts are accurate. Relate the amounts and other data relating to recorded transactions and events have been recorded appropriately. We record it appropriately and accurately. Cut off. Another assertion. Transactions and events have been recorded in correct accounting period. The transactions and events that we recorded, it is related to this year. Suppose we are recording the data of 2019. So the events which are recorded, these are related to 2019. Revenues of 2019 are recorded in 2019, and expenses of 2019 are recorded in 2019. It is not of 2018. It is not of 2017. What we recorded in 2019, it relates to 2019. So transactions and events have been recorded in correct accounting period. This is another assertions made by the management. Classification. Transactions and events have been recorded in proper accounts. each and every transaction that we recorded, amounts, each and everything, it is recorded in proper accounts. Keep in mind, revenues, capital expenditure and revenue expenditure, the distinction is made between these things. Capital expenditure are recorded in capital expenditure account, and revenue expenditure accounts are recorded in revenue expenditure account. This is just one example of this thing, that we record all the amounts in proper accounts. If there is purchase of land, so we record it in land. If there is purchase of building, we record it in building. If there is some other thing happens, so we record it in proper accounts. So these are the assertions, these are the claims of the management about the classes of transactions and events. The first thing, occurrence, that the transactions which are recorded, these transactions relate to the entity, to our organization, and these have been occurred. Yes, these have been occurred. Completeness, all transactions and events that should have been recorded have been recorded. We record each and everything. This is complete, nothing is missing. This is another claim of the management. Accuracy, we record each and everything accurately. And cut off, the data which is recorded, this is related to this accounting period. And the last thing is classification, we record each and everything in proper account. So they develop the financial record. When the management develop the financial record, they claim something about that, and we call it assertion. Assertion about the transactions and events. So these are the assertions of the management about the financial record, that each and everything, every transaction which is recorded, we are asserting about these things, that these are occurred, these are complete, these are accurate, these transactions, these relates to this accounting period, and we record it in proper accounts. So these are the assertions of management about the classes of transactions and events. And when auditor will come, he will check about all these things. I think for today it is enough. So inshallah in the next class, then we will talk about the assertion about account balances at the period end, and assertion about presentation and disclosure. So okay, have a good time.